Valens Research, Uniform Financial Analytics.
Alphabet, I assume all of you know who the company is. Alphabet specifically is, right, the most powerful search engine business in the world. And why are they Alphabet? Because the fact that they have companies spanning all types of things now, including YouTube, including Waymo, including everything that is, but still the bedrock of their business is Google. And when you look at Google and you look at Alphabet, one of the things that jumps out is where we start this analysis, which is in our PVP. And so our PVP, what we call it, is the performance and valuation prime. Again, we're very literal here at Valens. And the reason why we call it that is because we're looking at a company's performance and its valuation. Before we dig into the company and what we're seeing, I'm just going to really quickly turn on the as reported metrics, right? The company metrics that come out directly from the GAAP financial statements as opposed to our uniform accounting data. So you can see the difference between the uniform, these true blue bars, and the orange as reported distorted ROA for the business and the other metrics. So jumping in, always when we look at a company, the reason we start at the PVP, the performance and valuation prime page, is because it really does give us an excellent initial insight in terms of how the market is thinking about the company and how the company's performed. It's performance because the fact that we look at return on assets and asset growth in terms of what is the company's ability to generate profitability and actually reinvest in the business, right? You can really think about these two metrics combined as honestly a very simplified way to visualize free cash flow, right? When returns are high, you're generating a lot of operating cash flow. When investment is high, you're reinvesting in the business. And it helps you understand when ROA, when free cash flow can be negative, but returns can be positive, right? Which can be good for the business, et cetera. But if you want to buy a business, it's not just about understanding whether or not returns and asset growth are good, whether or not the company is a good performer. It's also about what the market is pricing the company to do, which is where we get to valuations. And we look at valuations two ways: value at asset prime, which is our price to book metric, and value to earnings prime, which is our adjusted PE metric for business. But jumping in for Google, one of the things that might jump out is you think about this business, right? It's a $1.6 trillion company. And yet, on an as reported basis, it's generating a 9% return on assets. That is an incredibly weak profitability business. And it has been for basically almost its entire life for a company that's now one of the biggest companies in the world. And the reason why is because as reported metrics totally misrepresent how profitable Google really is, how profitable Alphabet really is. Alphabet isn't a 9% ROA business. It's a 21% ROA business. And it was, as recently as 3 years ago, a 30% ROA business. This company throws off cash flow. It is a massively high return business. And not just that, it's actually growing even faster than as reported metrics help us realize. Right? When you look at Google on an as reported basis, you might look and say, yeah, I understand they have a great franchise, but they must be plowing so much money into these other businesses that aren't the Google search engine and ad revenue business, between Waymo, between Nest and everything else, that in reality, they've destroyed this business. They haven't. They're still throwing off cash flows and able to rapidly reinvest in the business as they do. But it's not just that. When we look at valuations, right, what we can see is at a 6 times uniform PE, right, and a 30 times ROA, valuations aren't unreasonable. And importantly, on a PE basis, this company is a lot cheaper than as reported metrics make us recognize. You look at this business on an as reported basis, you would see a company trading at 30 times, right, at 30 times PE that has ROAs that are bordering on cost of capital because they've overinvested everywhere in this business. You would run away from Alphabet and say, this is a short. At $1.6 trillion, there's no way it makes sense. But when we look at the uniform accounting, what we can see is a company that's still high return, still able to massively invest, and it's barely trading at market average levels, right? Average company in the market right now, seeing through short-term earnings, is trading at around 22 times. Alphabet is trading at market average returns with higher growth and higher profitability. And we only know that when we look at uniform accounting. But guess what? The market also knows that because the market's also paying attention to the uniform accounting data and not to the distorted as reported data. And we can see that because we can see the TSR for this company relative to the market. And for those of you who don't know, TSR stands for total shareholder return. That's a total capital appreciation and dividend income you can get from this stock in a given year. And the way to read this chart is when this line is flat, that means the company performed in line with the market. When it's rising, that means the company outperformed the market, the stock did. And when it's falling, that means the stock underperformed the market. And what we can see for Google is as the market understands that even with slight declines in returns, because the company is able to invest so much and still has high returns, the market's rewarding this business in a way we'd never understand or realize if we were looking at distorted as reported metrics. But that alone doesn't actually tell us whether or not we should buy or sell a stock. Because what we really need to know if we want to buy or sell a stock is to understand at that 22 times PE, what is the market pricing the company to do? And to look at that, we can use our embedded expectations analysis. What this tool lets us do is to say, what is the market pricing a company to do? And what's the company worth if we think that it won't? What I'm going to do really quickly here is I don't think any of us think that Google is going to grow at 9% a year. But if we look at these blue bars and white bars, what these blue bars here are, these light blue bars are, is what Wall Street analysts are forecasting Alphabet's return on assets to be the next 2 years when we push their estimates through the uniform accounting framework, right? They're projecting ROAs that were 21% last year to rise to 28% in 2021 and then plateau at around 25%. These white bars, these are what the market is forecasting Alphabet to do at a $1.6 trillion market cap and a $2.3 million, $2,300 stock price. It's pricing ROAs to plateau at 25% and growth to be slower than it ever has been historically, and ever than Google has been able to show that it can reinvest in the business. I don't think that any of us would think that Google actually is going to grow at that slow of a rate, considering that even at 2020, they grew at 15% a year. But let's actually give the benefit of the doubt and say that they're going to grow at 15% a year going forward. What the market is pricing Alphabet to do is for ROAs to be below where they were in 2020. So the market's still pricing in a fade for Google, right? A fade for Alphabet. What happens if we think that this ROA decline was really around very specific things in terms of their investing in, security and compliance stuff to make global governments happy. And like they had a plateau in ROA these years, they can probably plateau at 21% ROA levels. If we think that's the case for Alphabet and they can continue to grow at the lower end of where they've grown historically, all of a sudden what we can see is this company is still cheap at $1.6 trillion, as crazy as that is to say. And that's the powerful thing in conversation to have, because since we're looking at things from a uniform accounting perspective, what we can see is we can understand how should we really be modeling this company. We should be modeling actually a higher return business than we recognize and a higher growth business than the market may be forecasting, because the fact that we can see through the accounting noise and realize how wrong the as reported accounting was.
Valens Research, the world's leading source for uniform financial analytics.